Hi there, folks. This is Sean Bartek. I'm at the New Orleans Investment Conference, and I'm speaking to Stephen Dean, and he's the chairman and CEO of Atlantic Gold. This is a near-term gold producer working in Nova Scotia. They have advanced their projects from a patch of ground to almost ready to start pouring very, very quickly. That's because of the fact, I think, that Stephen and his team have actually done this before. They are real veterans, and they have money, they're cashed up, everything seems to be going well. Stephen, could you explain to my subscribers what Atlantic Gold is doing?
Sure. Well, we're in construction, John, on our project in Nova Scotia. It's the Moose River Consolidated Project. We're going to produce around 90,000 ounces a year at around $530 US all-in sustaining cash costs. We're in month 4 of a 15-month construction schedule. And we're hoping to be pouring gold in September, October of next year. We're fully financed, fully permitted. We're well on our way to pouring gold.
Yeah, so you guys already have 2 nice deposits that are a base case for your project, but you have other deposits beyond that, right?
That's right. We have 4 deposits drilled off for a total of in excess of 2 million ounces. 1 million ounces of those resources are in reserves, a category which, as you say, is our base case project. And we commenced in October of this year a program which will drill off to a high confidence level the other 2 deposits, and also we're targeting a couple of other advanced properties which we're planning to add to that resource base on top of that.
Great. What's the average grade on this?
The average grade is about a medium grade for an open pit deposit, about 1.5 grams, so very profitable at today's gold price.
But you also have low costs too, isn't that right?
We do have low costs. That's a function of relatively low strip ratios. It's a function of our location. We're about an hour or so's drive out of the provincial capital of Halifax in Nova Scotia, which means all the services, the infrastructure, all of those things. We're not flying fuel in from who knows where onto ice runways, which is common in Canada. This is a really easy location for construction and production.
There's a few things that I really like about what you've done here. One is that you did not have to dilute the stock a lot, because you were able to do a big debt financing to actually get most of the money you needed. The other is that you got a set price to build most of the structures there, right?
We have, yeah.
Could you explain that a little bit?
That's a little bit about our focus on exactly that shareholder dilution question. You don't want to be a serial issuer in this market, particularly as the market gets stronger. Some of the producers and explorers are tempted by that. We, as insiders, management and board, own in excess of 36% of the company, and that's because we put our own dollars in to the business, and we don't have all the money that the street has, so we are pretty frugal in terms of how do you minimize the capital, how do you minimize the dilution, partly with getting in senior bank debt and then using our own funds to top that up with the equity requirement. Mm-hmm. The other area you touched on is risk management. We are very focused, because we're large shareholders, on the inevitable risks that are inherent in our business. So, for example, the bill that you referenced there is on a fixed price contract. It means that any overrun on the build is not our problem, it's the contractor's problem, and we have bank letters of credit and other credit support to ensure that's backed up.
Great, and so that's kind of unusual for, say, like North America. That's more often done in Australia, Africa, and stuff like that.
Yeah, I believe it's the first in North America, right, in terms of a gold process facility construction contract, fixed price, fixed term. As you said, more common in Australia and West Africa, but I think this is the first here.
Good. There's a lot I really like about this, but if my subscribers were going to look at this project a year from now, what would they see?
What they would see is, all things going well, of course, is that we would be in production, in the early stage of production. We would be talking about extending our mine life and also annualized production as a result of the success that we're hoping to have in drilling off the additional 1.1 million ounces that are not in our mine life right now, and also maybe some new discoveries.
Okay, great. Atlantic Gold, near-term producer, low cost, has a lot going for it. We'll be taking a closer look at that. Thanks very much for speaking to my subscribers. Is there anything you'd like to add before we go?
That's perfect. Thanks,
Great.
Sean.
All right, you folks stay tuned. This is Sean Broderick from the New Orleans Investment Conference.